Good morning. Welcome to Chapter 12. In this chapter, we're going to focus on two areas that complement each other, including inventory and cost of goods sold. As we go through this, think about the process that we're going to follow. We're going to consider a risk assessment, assess the risk of material misstatement. We're going to focus on internal controls, and then finally, we're going to be talking about substantive testing. As an auditor, you're going to be spending a tremendous amount of time on the purchasing and inventory cycle. And this is for a good reason. There's special significance related to inventory. Management fraud has often involved overstating inventory. So determining the quantity of inventory requires, in some cases, specialized technique. Inventory represents, generally speaking, the largest current asset of an organization, and misstatements of inventory will directly affect cost of goods sold. Therefore, it will have a direct impact on our net income. So let's talk about some of the objectives related to our audit of inventory and cost of goods sold. Keep in mind that our objectives always relate to the management assertions. So one of the things we're going to do is to substantiate the existence of inventory, which means that we're going to do a physical inventory count. We're going to substantiate the occurrence of transactions related to our cost of goods sold, establish the completeness of the records of inventory, as well as the valuation of inventory. We want to verify the cutoff related to transactions affecting cost of goods sold. We need to determine that the client has rights to the inventory. As an example, the inventory may be on consignment. We need to establish proper valuation and determine the presentation and disclosure information related to inventory. The first step in understanding inventory is understanding the internal control environment within the organization. This is similar to some of the other things that we've talked about in prior chapters. We need to understand that there's a commitment to competency. There's appropriate human resource policies, that we are hiring the correct persons, that there is integrity and ethical values embedded within the organization from a top-down structure. Thus, the organizational structure and assignment of authority is based upon these ethical values, and we will understand this from the perspective as we examine the segregation of duties and the specific controls that are embedded in the inventory process. As we assess the risk related to inventory, we need to understand the impact inventory has on the organization. As an example, is this a retail organization where inventory is a significant piece of the overall revenue process? Is this a manufacturing where there is issues related to the allocation of direct materials, direct labor, and overhead? Or this may be an organization where inventory is not a significant piece, and in fact, we may be looking at supplies as opposed to inventory. The next issue that we need to understand from an organizational perspective is understanding the type of inventory. Is this inventory that's specialized? Are there unique valuation issues related to this inventory? Is there changing technology where the inventory may be obsolete in a short period of time? All of these issues are part of our risk assessment as we begin to understand the inherent risk and the appropriate control risk that is related to the risk of material misstatement. As part of our risk assessment, we need to understand the monitoring that is done by the organization. We need to observe what the production supervisors and others within the organization do in regards to the management of inventory and the manufacturing, if in fact this is a manufacturing environment. We need to understand any formal programs related to improvement. Perhaps there's a quality control committee that reviews changes to the product design. We also need to understand the fact that the internal audit group within the organization is probably conducting numerous audits directly to inventory and the purchasing cycle. These audit reports will provide a great window of understanding related to the internal control structure that the organization has in place related to inventory. Let's shift our attention to functions that relate directly to inventory. The first function that we want to talk about is the purchasing function. Now we'll go into more detail related to the purchasing cycle when we start talking about accounts payable, but keep in mind that what we have is we have the three-way process. We have purchasing, we have receiving, and then we have accounts payable. There needs to be a segregation of duties within this process, but even before purchasing, the individual department should not be responsible for actually placing the order. Individual departments should be requisitioning the product from the purchasing department. The purchasing department is responsible for negotiating contracts and pricing with vendors. From an IT perspective, the purchasing department is responsible for maintaining the vendor records within the IT system. These requisitions come in. The purchasing department then completes these by completing a purchase order that is sent to the vendor. This may require bids. There needs to be item description, quantity. All of these are then forwarded to the accounting department so that when the invoice is received, the item can be paid. You notice that there is a segregation between purchasing and receiving. The receiving department is going to receive the goods. They're going to record the receiving of these goods so that when the invoice is received, accounts payable is able to validate that yes, the item was ordered at a specific quantity, at a specific price, and that receiving has received the same quantity. Therefore, what accounts payable is able to do is to validate and affirm for payment the invoice because of this three-way match, and because they're able to rely on the segregation of duties throughout this process. In a manufacturing environment, storeroom is responsible for issuing goods to the requisitioning departments. As goods are requested, there needs to be controls in place to make sure that these goods are allocated to the appropriate job. We need to make sure that the master schedule is correct related to maintaining the direct materials, direct labor, and overhead. All of this then will flow through the manufacturing process so that at the end of the process, where we do a physical inventory count of our work in process and our finished goods, we can be sure that the costs are allocated appropriately. As we assess the risk of material misstatement related to inventory, we're concerned with cost and quantity. These misstatements could be caused by either fraud or error. An organization may be interested in overstating their net income. To get an overstated net income, what they may try to do is to understate cost of goods sold, which would require that they overstate their ending inventory. They may do this through a cost allocation system that's inappropriate. They may assign inappropriate costs to inventory, or there may be an intentional error related to the counting of inventory. The same outcome may arise not due to fraud, but due to error. The error is related to the allocation of cost, of pricing, as well as the inventory count. Generally speaking, when we see errors, we see ineffective internal controls. Therefore, as an auditor, we need to make sure that the internal control structure is appropriate for the function. Let's take just a minute to talk about another management assertion, and this is related to cutoff. So we want to make sure that the cost of goods sold is recorded in the appropriate period. This misstatement may be due to fraud or error. In any event, what we're looking for is we want to make sure that revenue and the appropriate cost of goods sold is reported in the period when the transaction actually was completed. Let's talk about some of the testing that we will complete as part of our substantive testing. Remember, substantive testing is where we measure monetary misstatement. Some of these substantive tests that we will complete includes reconciling the listing of inventory to our ledgers, the evaluation of the client's planning of physical inventory, an observation of the physical inventory, as well as making test counts. We want to review the year-end cutoff of purchases and sales transactions, obtain a copy of the complete physical inventory, test for its clerical accuracy, and trace test counts, evaluate the basis for inventory pricing, test the pricing of inventory. We will be completing analytical procedures related to inventory in terms of determining the inventory is reasonably stated. Finally, we want to evaluate the financial statement presentation related to inventory, cost of goods sold, and the adequacy of disclosures. The final piece of the inventory process that we want to talk about is the observation of the counting of the inventory. The observation of inventory count is considered a substantive procedure where we are assessing what management is doing in terms of the counting and pricing related to inventory. So you notice that what we do is an observation. Management is responsible for the actual physical inventory count. We are there as observers. We need to determine that all items are included, that employees comply with instructions. We need to be alert for the inclusion of obsolete or damaged merchandise. We need to record the number of final receiving and shipping documents issued before the inventory count is taken. We do test counts, and then we need to make sure that the inventory counting includes procedures to determine that items are included and none are included more than once. Okay, so I thank you very much for your time. This concludes our discussion, and I look forward to our next lecture.